Market revelations, the $524 billion question, Ukraine peace deal, and what it means for American investors. They said it couldn't be done. They said Putin would never negotiate. They said this war would drag on for years. But this morning, everything changed. President Trump just walked out of Mar-a-Lago with Ukrainian President Zelensky declaring, "I do believe that we have the makings of a deal." After an hour-long phone call with Putin and intensive negotiations, we are closer to ending Europe's bloodiest conflict since World War II than at any point in the past 4 years. This is not speculation. This is happening right now. The 20-point peace plan is 90% complete. Security guarantees modeled on NATO Article 5 are drafted, and the financial implications for American markets, your portfolio, and the global economy are about to hit like a freight train. In this emergency analysis, we're breaking down exactly what just happened in Florida. We're explaining why this peace deal triggers a massive capital reallocation across European markets. We're showing you the $524 billion reconstruction opportunity that American companies are positioned to capture. And we're preparing you for 3 scenarios that will determine whether your portfolio doubles or gets left behind. The breakthrough is real. The clock is ticking. Let's understand what happens next. The Mar-a-Lago breakthrough. It's Sunday, December 28, 2025. Most Americans are on holiday. But at Mar-a-Lago, history is being written. Trump spoke with Putin this morning for over an hour in what he characterized as good and very productive telephone call. Hours later, Zelensky arrived in Florida for face-to-face talks. This is not theater. Trump said previously he'd only meet Zelensky if he felt a deal was close. The fact that this meeting is happening tells us negotiations have reached critical mass. Why does this matter right now? Because Russia just launched 519 drones and 40 missiles at Ukraine overnight. The war isn't slowing down, it's escalating, which means both sides are feeling maximum pressure to either reach a deal or dig in for years of grinding attrition. The meeting was arranged after Zelensky held an hour-long call with Steve Witkoff, Trump's foreign envoy, and Jared Kushner. These aren't diplomats. These are deal makers, and they've structured this agreement like a business transaction. The 3 pillars of the deal. Let's talk about what's actually in this peace proposal, because the details determine everything. The framework includes 3 core components that completely reshape the geopolitical and economic landscape. First, security guarantees for Ukraine, similar to NATO's Article 5, hammered out over 2 days in Berlin. Trump is willing to bring these guarantees before Congress. This means American military commitment to Ukraine's sovereignty, even without NATO membership. This is massive. Second, territorial arrangements in the Donbass. The U.S. has offered thought-provoking ideas, including the development of an economic free zone in eastern Ukraine. Ukraine withdraws from certain areas, but Russia doesn't occupy them. Instead, they become demilitarized economic zones. Think Hong Kong model. Think special economic corridors. Third, the Zaporizhzhia nuclear plant. Zelensky proposes the plant be operated by a joint enterprise between the U.S. and Ukraine, with 50% of electricity going to Ukraine and the remainder allocated by the U.S. This isn't just about energy. It's about American companies getting operational control of Europe's largest nuclear facility. Here's why American negotiators structured it this way. The free economic zones create investment opportunities that offset territorial concessions. If Ukraine gives up physical control but retains economic participation, American and European capital can flow in immediately. Construction firms, energy companies, agricultural operators all get access to rebuild destroyed areas at Ukrainian labor costs, with American security guarantees backing the investment. This is the art of the deal applied to geopolitics. You're not just ending a war, you're creating the largest reconstruction opportunity since the Marshall Plan, and American companies are first in line. The $524 billion bomb. We need to talk numbers because this is where American investors make or lose generational wealth. As of December 31st, 2024, the total cost of reconstruction in Ukraine is $524 billion over the next decade, approximately 2.8 times Ukraine's estimated GDP. That's $52 billion per year average, but front-loaded spending will likely exceed $70 billion annually in the first 5 years. Where does this money go? Housing needs almost $84 billion. Transport infrastructure requires $78 billion. Energy sector needs $68 billion. Commerce and industry over $64 billion. Agriculture $55 billion. Debris clearance alone costs $13 billion. American construction equipment manufacturers are licking their chops. Caterpillar, Deere, heavy machinery exporters will see order books extending for years. Energy infrastructure companies like GE Vernova, Bechtel, power generation specialists get to rebuild an entire national grid from scratch. Every sector tied to large-scale infrastructure sees demand that can't be met by European capacity alone. But here's the critical detail. This year, Ukraine allocated $7.37 billion for priority areas, but a financing gap of $996 billion remains. There's not enough money. Even with European commitments and World Bank loans, the gap is enormous. This is where American capital markets come in. If Trump closes this deal and Congress ratifies security guarantees, suddenly Ukraine becomes an investable frontier market backed by American military commitment. Private equity firms, infrastructure funds, sovereign wealth can all deploy capital with political risk significantly reduced. The return profiles are extraordinary. You're rebuilding a country at distressed valuations with security guarantees from the world's largest military. Think about South Korea after the armistice. Think about Germany under the Marshall Plan. Early investors made fortunes. We're looking at the same setup, but with modern capital markets and deal structures that didn't exist in the 1950s. Scenario 1. Comprehensive peace. Within 30 days, let's map out what happens if Trump closes this deal before end of January. Probability, 35 to 40% given current momentum. European natural gas prices collapse 30 to 40% within 3 months. Between February and July 2022, European gas prices increased 115%. That war premium starts unwinding immediately as markets price in stable flows and reduced infrastructure risk. The euro strengthens 8 to 12% against the dollar as capital that fled Europe reverses course. German industrial production gets a massive tailwind from normalized energy costs. The DAX could rally 20 to 25% by summer as reconstruction orders hit German engineering firms. American defense contractors face headwinds. Lockheed, Northrop, Raytheon have been riding European military spending. If peace breaks out, those contracts get reconsidered. Defense stocks could drop 10 to 15% on peace news, but American infrastructure exporters explode higher. Caterpillar gains exposure to Europe's largest construction market. John Deere sells into Ukraine's massive farming sector. GE Vernova rebuilds power grids. These stocks could appreciate 30 to 50% as reconstruction contracts get announced. The real opportunity is smaller, specialized firms. American companies providing construction management, engineering services, project finance. Think Fluor Corporation, AECOM, KBR. These are names institutional money will chase once the deal is real. Scenario 2. Frozen conflict with partial ceasefire probability 45 to 50%. This is actually most likely given Russian demands versus Ukrainian red lines. Negotiations produce ceasefire along current lines, but without comprehensive peace or full sanctions relief. Military operations stop, but political tensions remain elevated. Reconstruction proceeds, but at slower pace. Without comprehensive peace and full Western backing, the financing gap stays wide. Private capital remains cautious. Insurance costs stay high. Project timelines extend. European energy prices decline, but remain structurally elevated. Instead of collapsing 30 to 40%, they drop maybe 15 to 20% and stabilize. Europe maintains diversification away from Russian energy. European industrial competitiveness improves marginally, but doesn't fully recover. For American investors, this creates selective opportunities rather than broad reconstruction boom. Energy security investments continue, LNG terminals, renewable projects, distributed power. Defense spending remains elevated across NATO, maintaining contractor revenue streams. Currency implications are muted. Euro strengthens modestly, maybe 3 to 5%. Dollar stays strong relative to historical norms. This supports American corporate earnings from European operations, but doesn't create the massive currency tailwind that comprehensive peace would generate. This scenario favors defensive plays over aggressive reconstruction bets. Energy infrastructure, selective defense contractors, logistics companies, and stable European markets. Avoid pure-play Ukraine reconstruction themes because capital flows won't materialize at scale. Scenario 3. Negotiation collapse and war escalation. Probability 15 to 20%, lower than other scenarios, but absolutely non-negligible given how negotiations could break down over territorial disputes or security guarantee specifics. Trump walks away. Putin walks away. The war escalates through 2026. European natural gas prices spike toward August 2022 levels as markets price extended conflict and potential infrastructure sabotage. German industrial production contracts as energy costs make manufacturing unprofitable. Recession across multiple European economies becomes likely. The euro crashes 10 to 15% against the dollar as capital flight accelerates. European equities decline 20 to 35% from current levels. The DAX, CAC 40, Italian indices all get hammered. American defense contractors see short-term gains as NATO spending increases. But even this becomes questionable as European fiscal constraints bite harder. Safe haven flows benefit U.S. Treasuries and gold. 10-year yields could drop to 3.5 to 3.8%. Gold tests $4,100 to $5,000 as geopolitical risk premiums surge. For American investors, this requires defensive positioning, increase Treasury allocations, hold gold, avoid European exposure entirely, focus on domestic equities and sectors that benefit from European weakness, energy exports, agricultural exports, defense. What American policymakers are watching. Trump's team isn't negotiating this out of humanitarian concern. They understand what's at stake for American strategic interests. First consideration, European energy independence from Russia. The administration wants Europe buying American LNG, not Russian gas. But complete Russian energy cutoff creates European economic collapse, which hurts American export markets. The peace deal has to thread this needle. Second consideration, NATO burden sharing. Trump has hammered European allies to increase defense spending to 2% of GDP minimum. The war forced this. Peace removes that pressure unless security architecture maintains enough tension to justify continued spending. Third consideration, containing China. Every dollar Europe spends on Ukraine reconstruction is a dollar not spent on Belt and Road alternatives or technology partnerships with China. Trump wants European capital flowing into American-backed projects, not Chinese infrastructure schemes. The Federal Reserve is watching energy prices. If this deal reduces European gas prices and feeds through to global commodity markets, inflationary pressures ease. The Fed gets more room to cut rates without risking inflation resurgence. This supports equity valuations. Congress will debate security guarantees. The Senate has to ratify any Article 5 style commitment. This will be contentious. Isolationist Republicans will oppose it. Progressive Democrats will demand reconstruction spending conditions. But if Trump frames it as economic opportunity for American companies, While forcing Europeans to pay for their own security, he might get 60 votes. The timeline: next 30 days. The next 30 days determine everything. Markets reopen fully in the first week of January. That's when institutional money makes positioning decisions for 2026. If this peace deal gets announced before January 15th, you'll see massive capital flows before most investors understand what's happening. Week 1, watch for the joint statement. If Trump, Zelensky, and European leaders announce a framework agreement, even without Russian signature, markets will price in 60 to 70% probability of peace. European equity futures gap up 5 to 8% overnight. Week 2, watch for Russian response. Putin has to either endorse the framework or reject it publicly. If he hedges with, "We need to study the details," markets stay volatile but optimistic. If he flatly rejects key provisions, we're back to Scenario 3. Week 3, watch for financing commitments. World Bank, European Commission, and private sector need to announce reconstruction funding. If you see $50 to $100 billion in commitments, the deal is real and capital deployment begins Q1 2026. Week 4, watch for corporate announcements. American companies will start announcing Ukrainian partnerships, joint ventures, contract bids. Caterpillar might announce equipment supply agreements. GE Vernova might announce power grid contracts. These corporate moves confirm smart money believes the deal is happening. How to position your portfolio right now. You're sitting at home watching this unfold. Markets are closed. You have maybe 36 hours before Asian markets open Sunday night. What do you do? First, understand that we're in scenario transition. The market has been pricing Scenario 2, frozen conflict, since summer 2025. Today's developments increase Scenario 1 probability from maybe 20% to 35 to 40%. That's a massive shift in expected value. The market hasn't fully priced this yet because institutional managers are on holiday. If you believe Scenario 1 is more likely than markets are pricing, you want exposure to European reconstruction winners and American construction infrastructure exporters. But be selective. Don't buy broad European indices. Target specific sectors. For aggressive investors with high risk tolerance, consider construction materials, heavy equipment manufacturers, engineering services firms. These are direct beneficiaries of $524 billion reconstruction spending. Look at companies with existing European operations and post-conflict reconstruction experience. For moderate investors, consider diversified industrial companies with multiple business lines including infrastructure, General Electric, Caterpillar, Deere. They're not pure plays, but they have significant exposure. For conservative investors wanting protection against Scenario 3, maintain core Treasury and gold positions while adding selective infrastructure exposure. Small position sizes in reconstruction. Exposed stocks give you optionality if peace happens, while your defensive positions protect if negotiations collapse. The currency trade is critical. If Scenario 1 happens, the euro rallies hard against the dollar. You need to think through your currency exposure and decide whether to hedge or embrace it. Option strategies make sense for this environment. If you believe Scenario 1 is underpriced but want downside protection, consider call spreads on European equity ETFs or American industrial stocks. The verdict: we are watching the most significant geopolitical negotiations since the end of the Cold War play out in real time. The 20-point peace plan is 90% complete. The security guarantees are drafted. The reconstruction financing architecture is mapped out. The $524 billion reconstruction opportunity isn't theoretical. It's real money that has to get deployed over the next decade. American companies are positioned to capture substantial market share if this peace deal closes. European markets are undervalued relative to the economic renaissance that peace would trigger. And the timeline for all of this is measured in weeks, not years. You have the position. You have the knowledge. Now you need the discipline. This weekend, while markets are closed, game out your scenario probabilities. Decide which outcomes you think are most likely. Position your portfolio accordingly and execute with conviction when markets reopen. Because if Trump pulls this off, if Putin agrees, if Zelensky holds the line on security guarantees while accepting territorial compromises, we're looking at the biggest wealth creation opportunity in European markets since the fall of the Berlin Wall. Subscribe to Market Revelations. The best is yet to come.